The first half of 2026 has been nothing short of a wild ride for US stocks, and as we head into the second half of the year, investors are facing a daunting list of risks that could make or break their portfolios. From the rising tide of interest rates to the looming US elections and the unpredictable impact of artificial intelligence, it's a complex web of challenges that's keeping even the most seasoned investors on their toes. The fact that the Federal Reserve is likely to continue raising interest rates to combat inflation is a major concern, as it could put a damper on economic growth and make borrowing more expensive for consumers and businesses alike. As we navigate this uncertain landscape, it's essential to keep a close eye on the market's mood swings, and that's exactly what we're seeing right now. Despite the risks, dip buyers are swooping in to lift US stocks, taking advantage of bargain prices and pushing the market higher. This is a crucial development, as it suggests that investors are still optimistic about the economy's prospects, even in the face of rising oil prices and tensions in the Middle East. The fact that oil prices are rising is a significant factor, as it could lead to higher inflation and impact consumer spending, but for now, it seems that investors are shrugging off these concerns and focusing on the potential for growth. Moving on to the world of commodities, we have a warning from Morgan Stanley's strategist, who's sounding the alarm on popular momentum trades like silver and semiconductors. The idea is that these trades have become overcrowded, making them vulnerable to a sharp reversal, and investors would be wise to shift their focus to more sustainable opportunities. This is a valuable insight, as it highlights the importance of staying ahead of the curve and avoiding the temptation to follow the crowd. By diversifying their portfolios and seeking out unique investment opportunities, investors can reduce their risk and increase their potential for long-term gains. Now, let's take a look at the global economy, where we're seeing some encouraging signs from China. After a sluggish few months, China's economy is showing signs of picking up, thanks in part to a rebound in shipments to the US. This is a significant development, as China is a major player in the global economy, and a resurgence in its growth could have far-reaching implications for trade and investment. The fact that US exports are rebounding is also a positive sign, as it suggests that the global economy is starting to gain traction. As we consider our investment strategies, it's worth thinking about the opportunities that exist outside of the US, particularly in the bond market. With interest rates on the rise, investors may want to prioritize countries with central banks that are raising rates or have different inflation dynamics. This could provide a hedge against the uncertainty in the US market and offer more attractive yields, making it a savvy move for investors looking to diversify their portfolios. By looking beyond the US border, investors can tap into new opportunities and reduce their exposure to the risks that are looming on the horizon. As we wrap up this Monday's Money Minute, watch for a crucial week of central bank meetings and economic data releases that could set the tone for the rest of the summer, and don't miss tomorrow's episode for a deep dive into the implications of a global economic slowdown.